Welcome to the deep dive. Today, we're going beyond the trench coats, the iconic ones, and taking a deep dive into Burberry's business performance. Just over the past year, you sent us their 2023-24 annual report and accounts, and wow, this thing is hefty. There's a lot to unpack here. Everything from their financials to growth strategies, even a peek into their sustainability journey. It's all in here.
Yeah, you're right. There's a lot there. I think it's really interesting to see how a brand, one that we usually associate with those Fashion Week runways and all that, is actually this complex, global business operating in a really challenging market.
For sure. So where do we even begin with something like this? I mean, this report's massive. Should we maybe start by trying to understand how Burberry actually makes money? What are the different pieces of their business? Like, how does it all work?
Yeah, absolutely. Let's kind of break down their business segments a little bit. The most the most visible part is definitely their retail network, those flagship stores you see in kind of like all the luxury shopping districts. They also have a growing online presence selling directly through their website and, apps and all that. And then there's the wholesale segment where they work with department stores and other retailers to kind of distribute their products more widely. Finally, they have a licensing segment where they earn royalties by letting other companies use the Burberry brand, like for fragrances and eyewear, things like that.
Oh, wow. So it's not just about selling those, high-end trench coats and handbags directly to customers. They've got this whole, ecosystem going on behind the scenes.
Exactly.
Okay, that makes sense. But in the report, they kind of highlighted some, regional differences in performance. Europe and Asia Pacific seem to be doing really well, but then the Americas seem to struggle.
Yeah.
What's going on there? What's the difference?
Yeah, well, I think if you kind of zoom out and look at the bigger picture, the whole personal luxury goods market, the whole sector, actually experienced a bit of a slowdown in the second half of the year. And this was really pronounced in the Americas, maybe due to a few things, a combination of factors like economic uncertainty and just kind of shifting consumer behavior.
Yeah, that makes sense. The report mentions something about aspirational consumers, I think, like pulling back on spending. What do they mean by that?
It seems like those shoppers who are kind of newer to luxury brands, the ones who are maybe stretching their budget a little more for those purchases, they became much more cautious when faced with all this economic uncertainty.
Right.
And what's interesting is this trend seems to have been strongest online. While Burberry saw 11% growth in sales from their physical stores, their online sales actually fell by 5%.
Adelanze, interesting. I thought, I always hear that online shopping is unstoppable. It's just growing and growing. Are you saying are luxury shoppers actually returning to physical stores?
It seems that way, yeah. It seems like in the luxury market, that experience of shopping in a boutique, that feeling of exclusivity and getting that personalized service, it still really matters. And I think for those aspirational consumers, maybe that in-store experience feels more justified when they're making a big purchase, when they're spending a lot of money.
Yeah, for sure. It makes it feel more like a special occasion.
Right.
So maybe those big ticket items feel a little less risky when you're actually there in the store. You can, touch the fabrics and get advice from the salesperson.
Exactly.
Okay, so tourism, did that play a role at all in the performance in different regions? Because the report mentioned that too.
Yeah, tourism definitely had an impact. The return of tourism, especially from mainland China, really fueled strong growth in Europe and Southeast Asia. But some regions, like South Korea, actually saw weaker performance, likely due to a mix of things. Again, economic factors and slower tourism recovery there.
Makes sense. Tourism is huge, especially for a global brand like Burberry. Okay, well, shifting gears a little bit, the report talked about a new creative direction for the brand. What's that all about? Is that just marketing speak, or are they actually making significant changes?
No, I think it's definitely more than just marketing fluff. The report introduces Daniel Lee as their new chief creative officer, and his vision is already having a big impact, I think. They're moving towards a more, I guess you could say, a more elevated and seasonally relevant offering, kind of moving away from some of those more playful or experimental designs they've done in the past.
Interesting. So are we talking a complete overhaul of their style, or just tweaks here and there? What kind of changes are we seeing in their collections?
Well, their winter 2024 collection is a good example, I think. It really emphasized outerwear, which makes sense. It aligns with their heritage and British identity, but it's with a more, modern and luxurious twist. Think impeccably tailored coats, really innovative fabrics, and just this overall focus on timeless elegance.
Oh, okay. So they're trying to like walk that line between staying true to their roots and then also like evolving to stay relevant in today's world, in today's luxury
Yeah,
market.
exactly. Yeah.
But speaking of making a statement, there was this whole thing in the report about a Harrods takeover. What was that all about?
Oh, yeah. That was quite a spectacle. So, to celebrate Harrods' 175th anniversary, Burberry basically took over the entire department store. They transformed it, decked it out in their signature night blue color. They even redesigned the doormen's uniforms, giving them a touch of that Burberry check.
Wow, that's pretty bold. Why Harrods, though? What was the strategic thinking behind that partnership?
I think it's all about reinforcing their brand presence in a key luxury retail space. Harrods is synonymous with luxury, right, and exclusivity. So this partnership lets Burberry tap into that and reach those high-end customers. It was a really visual reminder of Burberry's position as, a leading British luxury brand.
So they're making a statement with their creative direction, and they're making a statement with these big partnerships. It sounds like they're not afraid to, kind of take risks. But how is all of this translating into their financial performance?
Yeah.
I mean, the report mentions some pretty significant changes in their operating profit, their earnings per share. Like, what's the story there?
Yeah, so let's break it down a little bit. Their adjusted operating profit, which, that excludes certain one-off or unusual items, came in at 418 million. But that's actually a 25% decrease compared to the previous year when we factor in constant exchange rates.
Okay, so a pretty big drop in profitability.
Yeah.
But what's driving that? Is it all due to like the slowdown we talked about, that slowdown in the luxury market?
That's a big part of it for sure, but there's a little more to it than that. Remember those unfavorable exchange rates? Those also had a pretty big impact on their bottom line. The report mentions a 60 million pound hit from all the currency fluctuations. So basically, the money they earned in other currencies, it just didn't translate into as many British pounds when they had to, convert it back.
So it's a double whammy.
Yeah.
A challenging market, A&D, a weak pound are squeezing their profits.
Yeah, pretty much.
What about those other numbers, though? Like you mentioned, earnings per share. What does that tell us?
Their adjusted diluted earnings per share, which is basically how much profit they're making for each share of stock, also dropped by about 30%, even after adjusting for those currency fluctuations. So again, this shows us just how hard they were hit by that market slowdown and that weak pound.
So it's not just a decline in overall profits. It's a decline in like the value they're creating for each share of stock.
Yeah.
Okay, that makes sense. But the report also mentioned some other metrics, things like adjusted operating margin and ROIC. Are those important too?
Definitely. Adjusted operating margin basically tells us how much profit they're making for every pound of sales, and that actually decreased by 500 basis points, which means their profitability took a hit. And then ROIC, that stands for return on invested capital, and that measures how effectively they're using the money invested in the business to generate profits.
Got it. So essentially, it's all about making sure those investments are actually paying off, especially when times are tough.
Right.
But what about like giving back to the people who invested in Burberry, the shareholders? Any news on dividends or buybacks?
Yeah, so Burberry actually has this really clearly defined capital allocation framework. It basically outlines their priorities for using their cash,
Okay, so what's at the top of their list? What do they prioritize?
Reinvesting in the business for growth. They really want to use their cash for things like, opening new stores, upgrading their tech systems, and making their supply chain more efficient. They see these as essential for the future.
Yeah, that makes sense. You got to keep things running smoothly, and you got to keep innovating to stay ahead, especially in the luxury game.
Absolutely.
But, rewarding those loyal shareholders, that's important too, right?
For sure, and that's where those dividends come in. Burberry has a progressive dividend policy. They're aiming to pay out around 50% of their adjusted earnings per share to shareholders every year. And the key here is progressives. They're trying to keep the dividend per share either stable or increasing it year over year.
So even though they're facing challenges, they're still committed to sharing their profits with their investors.
Exactly.
But, the report also mentioned share buybacks. What's the deal with those?
So share buybacks are another way to return value to shareholders. Basically, during the year, Burberry completed a $400 million share buyback program. What that means is they repurchased a bunch of their own shares from the market.
Okay, but why would they do that? What's the benefit of buying back their own stock?
Think of it like this. They're consolidating ownership. When a company buys back its own shares, it reduces the total number of shares that are out there, which can potentially increase the value of the remaining shares.
Okay, so it's like they're making the pie smaller, so each slice is worth more.
Yeah, exactly. Each remaining share represents a larger ownership stake in the company, and they have a bigger claim on its earnings.
Okay, so we've covered a lot, from those different business segments and the regional performance differences to their new creative direction and all their efforts to reward shareholders. But honestly, I'm feeling a little overwhelmed by all these numbers. Is there a way to simplify it, to get a clearer picture of their overall financial health?
Absolutely. Let's shift gears and look at their key financial statements. The income statement, balance sheet, and cash flow statement. By really analyzing these, we can get a much deeper understanding of how they're managing their money and creating value.
Okay, I'm ready to dive into those numbers.
All right, so let's start with that income statement. It basically gives us like a snapshot of their financial performance over the past year.
Okay, so this is where we see how much money they brought in versus, how much they spent, right?
Yeah, exactly. And one of the first things we see is their revenue, which came in at $2.968 billion. Now, that might sound like a lot, but it's actually a 4% decline compared to the year before.
A decline in revenue, not a great sign, right?
It definitely reflects the challenging environment we talked about, that slowdown in the luxury market, the impact of those unfavorable exchange rates. All those things took a toll.
Yeah, for sure. So revenue's down. What about their costs? Were they able to kind of keep those in check at all?
Unfortunately, no. Their cost of sales actually increased by 5%. So that basically means it's becoming more expensive for them to actually make their products, maybe because of like rising material costs or labor costs, something like that.
So they're bringing in less revenue, but it's costing them more to make their products.
Mm-hmm.
That's not a recipe for success.
No, it's not. And that's reflected in their gross profit, which is basically the profit they make after subtracting their cost of sales from their revenue. That dropped by 8%, coming in at $2.0009 billion.
Okay, so we're seeing a pretty clear impact on their profitability.
Yeah.
But you keep mentioning these like adjusted figures. What's the difference between the adjusted numbers and like the reported numbers?
Yeah, that's an important distinction. Reported figures, those reflect the company's actual financial performance according to, accounting standards, the rules. But sometimes these figures can be a little misleading because of one-off or unusual items that don't really reflect the actual, underlying trends of the business. The adjusted figures kind of take those out to give us a clearer picture of their core operation.
Oh, okay. So it's kind of like taking out the noise to get a clearer signal.
Exactly. In Burberry's case, their adjusted figures help us understand how their core business is really performing. Stripping away the impact of things like those exchange rate fluctuations we talked about, or any one-time charges.
Right. Okay, so when we talk about their adjusted operating profit being down 25%, we're getting a more accurate view of their profitability, right?
Yeah.
Of how things are really going.
Exactly, yeah. Okay, so now let's move on to their balance sheet.
The balance sheet, that's where we see what they own and what they owe, correct?
Exactly, yeah. It's basically a snapshot of their financial position at a specific point in time. And one interesting item on their balance sheet is their inventory. For a fashion brand like Burberry, inventory is crucial. It's all those clothes, accessories, all those goods they have ready to sell.
So basically, a giant pile of trench coats and handbags.
Yeah, you got it. At the end of the year, their inventory stood at $507 million. However, they also had, $73 million in inventory provisions.
Provisions, what are those?
Think of it like a safety net. It's this accounting thing where companies set aside some money to cover any potential losses on their inventory.
Oh, okay. So if some of those trench coats go out of style.
Yeah.
Or get damaged or something.
Yeah, that's one possibility. The inventory provisions can cover different scenarios styles that become outdated or damaged goods, even things like theft, things like that.
So even though they have all this inventory, they're being cautious and setting aside some funds just in case.
Mm-hmm.
It's acknowledging that not every trench coat is going to fly off the shelves at full price.
Exactly. All right, now let's move on to the cash flow statement, which is where we see the actual money, flowing in and out of the business.
Okay, here's where it gets real. Cash flow king, right?
It is. It's the lifeblood. The cash flow statement basically shows us how much cash Burberry generated from their operations, how much they invested, and how much it financed.
Okay, so let's start with that cash flow from operations.
Yeah.
This is the cash they generated from their core business activities, selling all those trench coats, handbags, all that good stuff. How did they do?
Well, their cash flow from operations actually declined by 35% to $483 million.
Another decline. Starting to feel like a broken record here.
I know, I know. But it's important to remember that cash flow can go up and down from year to year. It's affected by different things, like changes in working capital, which is basically the money that's tied up in their day-to-day operations.
Oh, okay, like having enough cash on hand to pay their suppliers and employees, keep the lights on.
Right, exactly. Now let's look at their investing activities. This is where we see how much they spend on things like opening new stores, upgrading equipment, acquiring other businesses, things like that.
So investments in their future growth, were they spending a lot?
Their capital expenditure, which is a big part of those investing activities, came in at 178 million pounds.
Okay, so they're still investing in growth, even though their cash flow is down. Seems like they're walking that tightrope. Trying to balance being cautious, but also staying competitive.
Yeah, exactly. Now, let's see where they actually got the money for all these investments. That's where financing activities come in.
Financing activities, that sounds like loans, things like that.
Right, things like issuing debt, raising equity, or paying dividends. One notable item in Burberry's financing activities is their share buyback program. The one we talked about earlier. They spent a good amount of cash buying back their own shares.
Right, that 400 million buyback program,
Yeah.
that used up a chunk of change. But didn't they also pay dividends to shareholders?
They did. They returned 233 million to shareholders through dividends throughout the year.
So even though their cash flow is down, they're still focused on returning value to those shareholders through dividends and buybacks. It's a balancing act for sure.
It is. Now let's talk about free cash flow. This is a really important metric, often considered like a key indicator of a company's financial health.
Free cash flow, right? What's that all about?
Free cash flow is basically the cash a company has left over after paying for all their operating expenses and capital expenditures. It's the cash they have available to invest in growth, pay down debt, or, as we've seen, return to shareholders.
Sounds like their financial wiggle room. The more free cash flow they have, the better.
Generally, yes. Having a healthy free cash flow gives companies more options, more financial flexibility. Now, the report doesn't actually tell us Burberry's free cash flow number directly, but we can actually calculate it based on the numbers we already have.
Oh, we can. Let's do it. I'm always up for a little financial detective work.
So remember, their cash flow from operations was 483 million pounds, and their capital expenditures were 178 million. To figure out their free cash flow, we just subtract the capital expenditures from the cash flow from operations.
Okay, so 483 million minus 178 million. That gives us, hold on, let me just double check, 305 million in free cash flow. Not bad, considering all the challenges they've been dealing with.
You're right. While their free cash flow is positive, it has declined compared to the previous year. So it's something to kind of keep an eye on.
Right, that decline trend again. But hey, at least they still have cash available to, reinvest in the business, maybe pay down some debt or reward those loyal shareholders.
Exactly. Now, with all these numbers in mind, I think it's time to step back and think about how Burberry plans to create shareholder value moving forward. It's one thing to talk about dividends and buybacks, but what's their overall strategy for keeping those investors happy? That's a big question.
All right, so we've really dug into Burberry's financials. We've seen how they're balancing investing for growth while also rewarding those shareholders.
And that's really where their capital allocation framework comes in. It's basically their plan, their roadmap for creating shareholder value.
Okay, so remind me again, what are their top priorities when it comes to actually using their cash?
First and foremost, it's reinvesting in the business in what they call organic growth. So pouring money back into things like opening new stores, upgrading their technology systems, and making their supply chain run more efficiently.
Right, like taking care of the core business, making sure it's healthy and growing.
Exactly. It's all about laying the groundwork for long-term sustainable growth. And then, once they've taken care of those essential investments, their next priority is returning cash to shareholders.
Which is where those dividends and share buybacks come in.
Exactly. Remember, they're aiming to pay out around 50% of their adjusted earnings per share, so they're committed to sharing a good chunk of their profits with those investors.
So half their profits go back to the people who own the company, basically. That's pretty generous, especially in a year when profits are down.
It is, and it shows how important those shareholders are to them, even when times are tough.
Yeah.
And then you've got those share buybacks, which can further increase shareholder value by reducing the number of shares that are out there,
Right. So it's a two-pronged approach. Dividends provide a steady income stream, and buybacks can boost share price. But even with all that, are they doing enough to actually face those challenges we talked about? The competition, the economy, changing consumer tastes. What makes you think they can pull it off?
Well, let's not forget about their biggest asset, their brand recognition. That iconic Burberry check, the classic trench coats. They represent this heritage of quality and craftsmanship that people all over the world recognize.
Yeah, there's definitely a certain something about owning a Burberry piece. It's not just fashion, it's a statement.
Absolutely. But they're not just posting on their reputation. They're bringing in new ideas, a fresh perspective with Daniel Lee's creative direction.
Right, shaking things up a bit, appealing to a new generation of luxury shoppers.
Exactly. And they're doing it while staying true to those core values that made them successful in the first place. They're expanding their stores, both physical and online, to reach more people. They're creating these really high-end, seasonally relevant pieces for those discerning customers. And they're building relationships with those top spenders, those elite clients who drive so much of the luxury market.
Sounds like they have a plan, a solid strategy. But what about their sustainability efforts? We've talked about how they're incorporating sustainability into everything they do. But is it really more than just a trend? Are they really committed?
I think they're beyond strategy with its focus on the product, the planet, the people, and the communities they work with really shows they're taking a holistic approach. It's not just a marketing thing, it's in their DNA. They're setting targets, tracking their progress, and they're even linking executive bonuses to those sustainability goals.
Wow, so they're putting their money where their mouth is.
Literally. Exactly. And I think that really resonates with today's consumers, especially younger ones, who really care about transparency and ethical practices from the brands they support.
So, wrapping up this deep dive into Burberry, it's clear they're facing some headwinds, some tough challenges, but they're also taking proactive steps to address them. They're this heritage brand with a modern vision, committed to creating value for their shareholders and for the world. But, what stands out to you most from this deep dive? What makes you think about Burberry differently now?
What really strikes me is this commitment they have to balancing heritage and innovation. They're not afraid to embrace their past, but they're also looking ahead and anticipating how the world is changing. And they're doing it all with this sense of purpose, understanding that a successful business needs to be profitable, and responsible.
Yeah, it's like they're threading a needle,
Yeah.
carefully weaving together tradition and progress. It makes you wonder, can they keep this up? Can they navigate the challenges of the luxury market while staying true to who they are?
That's the big question, right? And it'll be interesting to see how it all plays out. But I think for now, it's safe to say they're on the right track. Definitely a company to watch.
Well said. Thanks for joining us for this deep dive into Burberry. It's been fascinating to go beyond those trench coats and see the business behind the brand. We'll be back soon with another deep dive, another listener-submitted source material. Until then, keep exploring, keep learning, and keep those questions coming.